On March 16, 2022, the Fed raised interest rates above their previous near-zero levels for the first time in 2 years. And while there's a lot of variables that are still very much up in the air at the time that I'm recording this in early April, many experts are expecting additional interest rate hikes in the future. And that's understandably gotten some investors on edge, especially when you pair it with the fact that inflation is higher than we've seen in decades, and the stock market already appears overvalued by many traditional metrics like the various price-to-earnings ratios that are out there. With that being said, while none of us really know for sure what the future holds for our investments, it can be helpful to look back at history to see what typically happens when interest rates are hiked like this, as it'll give us an idea of what we may be in for over the short and long term. So that's what we're going to be doing today. Let's discuss how the stock market typically performs following a rise in interest rates over the short and long term, and what that means for us as investors. But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. And if you want to further support this channel, you can check out some of the links I've left in the description below, which includes a link to the investing platform M1 Finance. Get started investing for free today. So before we get into the actual data, I wanted to discuss how I went about categorizing the different eras of rate hikes, because the reality is that the periods of rising interest rates are not always strictly linear. There are times where the Fed will start raising interest rates, but then, for a variety of potential reasons, will briefly drop them back down slightly before going back to raising them again. For example, according to data from the Federal Reserve Bank of St. Louis, the Fed began to raise interest rates in December 1986 from about 5.88% to around 6.75% by May 1987. In July, they dropped the rate to around 6.63%, before raising it back to 6.75% in August and then hiking it again in September to around 7.31%. And that pattern leaves me with a bit of a problem. Should I be counting that stretch as one period of raising interest rates, or two? On the one hand, it may not seem like such a big deal since, at least in this particular case, the Fed only dropped rates for 1 month. But that isn't always how it goes. Take what happened later that very same year, for instance. In November, the Fed began dropping rates again, from a high of around 7.3% down to as low as about 6.5% in February 1988. Then they resumed raising rates to an eventual peak of about 9.81% by May 1989. Should that count as yet another unique period of rising rates? I mean, this time the rates dropped by almost a full percentage point, and it took place over the course of 4 months. Ultimately, here's how I decided to handle it. I looked at every time the Fed raised rates by at least half a percentage point from where they were before the first rate hike was announced. I then ignored any of those temporary drops in the rates as long as a new high point for interest rates was reached within a year of the initial drop. So going back to our example, rates were at about 5.88% in December 1986. They rose to a then high point of 6.75% in May 1987. We ignore the drop in July because by September, we had already reached a new high point in interest rates of 7.31%. From there, we again ignore the rate drop that began in November because by June 1988, we reached another new high point of 7.44%. The rates continued rising until they reached a new high point of 9.81% in May 1989. Then, starting in June 1989, rates began to drop, and since the rates did not surpass that high point of 9.81% by June 1990, that would be considered the end of the rising period in this instance. I hope that makes sense. Basically, the period starts with the first rate hike, assuming interest rates eventually did rise by at least half a percentage point, and ends after we reach a peak that isn't surpassed within a year of the Fed dropping rates. The reason I did it this way is because if I looked at every single instance in which the Fed rose rates by any amount, there'd be way too many examples to make much sense of. But with that being said, viewing the eras of interest rate hikes in this way leaves us with 11 distinct periods of rising rates over the last 50 years, excluding 2022 since, at least at the time of this writing, rates have only been hiked by 1/4 of a percentage point. The 11 periods are detailed in this chart. When all is said and done, it seems that, on average, interest rates ultimately will rise about 2 to 4% from where they started, with a couple notable exceptions in the 1970s. And it typically all takes place over the course of roughly 1 to 3 years, at least based on how we're categorizing these periods. With that being said, now that we've gone over how we're categorizing these interest rate periods, let's look at how the markets actually responded. I looked at the total return of the S&P 500 for each of the 11 periods at 1, 3, and 6 month intervals, as well as 1, 3, 5, 10, and 20-year intervals. And, on the whole, the results are fairly promising. On average, the market held fairly steady, gaining between 0.2 and 0.4% in the month and quarter following the initial rate hike. Though it is worth noting that in each of the last 4 periods since 1994, the markets have dipped between 1 to 7% in the month after the hike, and lost some ground by the 3-month mark in 3 of the 4 periods. 6 months after a rate hike, the markets typically were up about 6%, and after 1 year, the markets are up on average about 11%. 3 years down the road, the typical overall gain hovers around 31%. 5 years out, it's nearly 77%, and at the 10 and 20-year marks, the average gain clocks in at around 197% and 890% respectively. On an annualized basis, that suggests average compounded returns of about 9.5%, 12%, 11.5%, and 12.1% for the 3, 5, 10, and 20-year periods, respectively. Median gains were in a similar ballpark to the average figures, if slightly lower in most cases. At the low end of the spectrum, we saw about a 7% fall off 3 months after the rates were initially raised in 1975, and a double-digit overall drop at the 3, 5, and 10-year marks following the rate increases in the summer of 1999, because of course, in the 2000s, we had not 1, but 2 market downturns. At the upper end of the spectrum, we've seen similar rises at the 1 and 3 month marks as we saw drops. We've also seen double-digit gains at the 6-month mark following the hikes in 1982 and 1987, and triple-digit growth at and beyond 5 years following the 1982, 83, and 94 hikes. The 2015 hike also nearly hit that mark, rising a total of 98.2% in the 5 years following the initial rate hike. Now, I don't know about you, but to me, those are generally some pretty promising numbers. It suggests that over the last 5 decades, a worst-case scenario amounts to annualized losses of anywhere between 2 and 12% per year, depending on what multi-year period you're looking at, with the rate of losses slowing down as the time horizon expands. And while seeing the value of our nest egg go down, especially by double digits, is never exactly fun, it certainly could be a lot worse. And the only interval that showed a crash was the 3-year minimum following the 1999 hike. For the record, a best-case scenario for those same multi-year periods produced annualized returns of anywhere from 15 to 26% per year. So, even though there certainly was some risk of losses, the risk-reward trade-off over multi-year time horizons certainly doesn't look too bad, especially when you consider how many of the periods had positive growth figures over each time interval. As you can see on your screen now, the only time intervals that had less than a 4 and 5 shot of producing at least positive returns were the 1 and 3 month intervals, which produced positive returns in 7 of the 11 cases we're looking at, which is nearly 2/3 of the time. What's also impressive is how quickly the market has risen to new heights following rate hikes. As you can see on your screen now, the longest it took for the markets to eclipse their value before the rate hikes were announced was just 7 months, which came during the 1994 rate hike. Even the initial rate hike this year has already been followed by a new high set in April. So in short, on average, the markets seem to do fairly well following the onset of interest rate hikes. More often than not, they produced positive growth, at least over the intermediate and long term. And while there is a fair bit of variability in the outcome of any given period of hikes, it seems that even in the worst case scenario, new highs are reached within a year. To me, this suggests that there's likely not much reason for panic as investors. There's certainly precedent for rate hikes to cause short-term volatility in the markets, and if we should hit some economic turbulence in the near future, kind of like we did when the dot-com bubble and Great Recession hit a few years after the initial rate hikes of 1999 and 2004, it's possible that we'll see our investments take a fairly noticeable hit. But over the long term, it seems that things tend to work out. So as far as what we, as investors, should be doing to handle this situation, it would seem that the history suggests that we really shouldn't be doing anything different than we normally would. If you're in a position where you're financially able to invest, then, if history is anything to go by, over the long run, it's unlikely to be a decision your wallet will regret. And to illustrate that point further, I went back and ran a few simulations to test whether altering our behavior during periods of interest rate hikes would be beneficial to us as investors. The first simulation had an investor, let's call him Bob, sell his investments in the stock market whenever interest rates rose at least 0.5% from where they initially started, and then he would buy back in. The second simulation had another investor, we'll call her Jackie, stop adding money to her nest egg each month, but keep the money that she already had invested right where it was. She didn't stop saving money, she just opted to keep that newly saved money in a safe place until after interest rates peaked, at which point she'd put everything that she had saved during the rising rate period into the markets with the rest of her investments. The third simulation had John simply stay the course. He didn't change anything about his approach, regardless of what was happening with interest rates. And finally, the fourth simulation had Jane start investing even more money than normal during periods of rising rates. All 4 investors saved $500 a month, with Jane adding an additional $100 a month during rising interest rate periods. And they put all of their money into a simple S&P 500 index fund. Here were the results for the period starting in January 1971 and going through March 2022. As we can see, similar to when the stock market crashes, the last thing we want to do is panic and sell our investments like Bob did. Sure, he still ended up a multi-millionaire using these assumptions, a credit to the miracle of compound interest if ever there was one, but compared to our other 3 investors, his nest egg comes up quite a bit short. Jackie more than tripled Bob's net worth. John did slightly better, due in large part to the fact that he always made sure to keep his entire nest egg working for him, whereas Jackie would occasionally keep a small portion of her money temporarily on the sidelines as she waited out the rise in interest rates. And finally, as we would expect, Jane did the best. Obviously, she made sure all of her money was always working for her, just like John did, but she also tightened her financial belt more than he did. And as a result of that added out-of-pocket investment, she managed to finish with the largest nest egg of them all. But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. I generally upload every single Monday, and if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.